I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Show, and today is June 13th.
And yesterday we had a really, really big day. June 12th, we had inflation numbers, and the Fed rate was talked about after the meeting. And very rare have those things come together at the same time.
Yeah, same day, inflation and the Fed meeting, and it has a lot of implications for interest rates. So if you're in the market looking to buy or sell a home here in Phoenix, Arizona, where we are located, or if you're a real estate agent or anyone in the business of real estate, we're going to look at a forecast of where interest rates might be based off of what Jerome Powell said.
That's right. And we didn't find this anywhere. We had to actually scrub the video to find what you're going to see. You're going to like it.
Yes. So core inflation is down to 3.4%. Again, this was yesterday morning. The core inflation is down, and core inflation is without food and gas. And inflation is down to 3.3 from the 3.4 estimate.
Now, some of the headlines that we saw this morning, they weren't conflicting, but they didn't quite get the message across because they said inflation numbers, didn't come in. They came in at the same. They weren't elevated like they thought they were going to, but yet you're reading these numbers and it's showing that it actually did come in lower.
Yeah.
So the market's still analyzing and trying to digest this information. But based on what we just told you right now, this is a little more positive on the inflation front than what I thought this morning.
Yeah. So right, this is according to the baby pips. They follow all the economic news, but again, different estimates can be out there for forecasts. Okay, so the Fed obviously spoke. Jerome Powell, the Fed, again, the Fed rate is at a 23-year high, and he only projects one cut this year.
And I think it's easy just to gloss over that 23-year high. What does that mean? It just means we are really in a historical time period.
Yeah,
23 years.
And we're going to show you a chart here. Of this as well, but. Of the Fed rate. But Jerome Powell, this is right from his speech. These are his words. The economic activity has continued to expand at a solid pace. What does that mean? I mean, it means that the economy is still pretty solid. It is not showing really a lot of weakness. Job gains have remained strong and the unemployment rate has remained low. Just last Friday, the jobs report came out really strong.
Yeah, but at the same time, the unemployment rate crept up, which was like a total mind tease. How do we have stronger job numbers, but yet unemployment goes up? Well, that's because more people are getting into the job market. It's a really, really big deal.
Yeah, and there was also conflicting news last week. The ADP report, job openings from the JOLTS job openings, it was also showing lower. So kind of conflicting. But he also did say inflation has eased. That's the most important keyword there. Eased over the past year, but remains elevated. In recent months, there has been modest further progress towards the committees. That's the Fed committee. There's 12 committee members. They're called Fed governors. The committee's 2% inflation objective.
So I would say if we were to make this analogous to a train, and the train is inflation, and this train is going faster than what they feel safe, for the market, the train has definitely slowed down from its peak, a year and a half ago or 2 years ago, but it's not slowing enough to make them want to reduce the interest rates. So he's talking not out of both sides of his mouth. Inflation is still an issue, but it is definitely easing, but it hasn't gotten to that point where he can pull that lever back.
Yeah. So Jerome Powell also said in his speech, he expects, based off of the data that they're looking at right now, if things go according to plan, of course they rarely ever do.
Yeah, and they always,
they never. I mean, in fact, you would say again, based off the data they have, if it happens, this is where he expects the Fed rate to be.
Kind of like a weather forecaster, as of today, tomorrow, the snow is going to start at 6 a.m. We'll just wait till tomorrow morning.
Yeah,
it'll be at another time. So as of now, this second, this is what he's saying.
So he thinks the Fed rate. Now, again, this is not mortgage rates. This is the Fed rate. Fed rate right now is at 5.25 to 5.5. That's
they always give you a range.
Yeah,
it's never an exact
he says
number.
That they expect the Fed rate to go down to 5.1 by the end of 2024, 4.1% by the end of 2025, 3.1% by the end of 2026. Again, 6 months from now, that's the end of 2024. We're already halfway through 2024. And then 18 months from now, maybe 4.1. And then, what's the 30 months from now, 3.1%.
Yeah, right. And we were talking just how long of a time period this is.
Yeah.
Everyone's talking about, things are going to, they'll be changing. This 2026, we just said. That just came out of our mouth. That's still a long time. But look at where it's going. It's going in the right direction.
So we have this chart on the map, or on the screen here. It shows in red the 30-year fixed historical rate mortgage, or the history since 2016. That's the 30-year fix. And then the blue is the Fed rate. And what I want to show you is that the Fed rate is always lower. I'm going to say always. It's really never above, because it's such a short-term rate, that there's always a spread. The difference between the 30-year fix and the Fed rate, and that's that distance between. You can see here in my little arrow. This is the spread. It's the distance between that red line and the blue line, and the average historically is about 1.5% to 2%. But right now it's at 1.75. The point is there's always a spread, and so what we can do is we can forecast, or get a given estimate based off of this, of where interest rates will be based off of what Jerome Powell has said.
Now, I was hoping we'd have a drum roll when we got to this slide, because this slide is so good. I don't think I've seen this anywhere. I don't think we've done a slide just as meaty as this by itself. Look at this. We're basically predicting using the Fed's words on where we think rates are going to go out to 30 months.
And using the spread. So basically 5.1%, if that's what the Fed rate is by the end of 2024, we can expect we can estimate that rates, the 30-year fixed mortgage rate would be 6.6%. Again, estimate. Could be higher, could be lower.
And just as a baseline, as of today, they're about 7. Okay, if we use the the national average at about just a hair under 7. So going out to the end of the year, it's down almost 0.5%. Almost.
And then, so if you at the end of 2025, so in 18 months, if the Fed rate's at 4.1, the mortgage rates, the 30-year fix, could be 5.6.
And that feels really good.
Yeah, that would be
anything in the
pretty
5s.
Significant drop. And then within 30 months, that's to the end of 2026, the Fed rate, if it's 3.1%, mortgage rates will be in the 4s.
Yeah.
And I think it's kind of good to see. It takes time. It isn't like these things are coming down to 4% in the next 6 months or the next 12 months.
Yeah. And you know what? And it wouldn't be too far-fetched to say, what do we think would happen in 2027? I mean, you could carry this conversation and say it could theoretically be 2.1 for the Fed, fund rate. So at that point, again, eventually we could get right back to where we were, 4 or 5 years ago.
And we're just going to end here with the 30-year fix at 6.98% today. The 15-year fix at 6.4%.
Yet the 30-year FHA, 6.42, and the 30-year VA, 6.45. You always note the FHA and VA are super close.
And again, this is from Mortgage News Daily. Tom and I, we're the Mortgage Brothers team right here in Phoenix. If you have any questions, if you like what we're doing, be sure to subscribe, comment, and like. We'll be back with another video.
All right. Hey, thank you, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.